Good morning, all of you. My name is Fazal, and I'll be taking your the Indian economy part. I believe that the basics of Indian economy with respect to GDP and GNP has already been covered. So, considering this, I will take a little bit the basics of those GDP part, and quickly we'll move into second chapter of the banking. So let me start with what is the basics. See, aspirant should understand the basic part, which is nothing but GDP, which is nothing but the gross domestic product. I'll just give you a small, synopsis about the GDP, and we'll quickly go to the second important topics which are not covered. So remember, GDP is nothing but the gross domestic product. So any good, okay, which is being produced within a country, okay, which can be any of the entities like goods or the services, okay, whose value gets contributed to the GDP. So GDP is nothing but where you have produced the good which has a territorial borders, territorial limits. This is called as GDP. And when we consider GNP, which is gross national product, so this is nothing but the total income of the country, nothing but the total income of our country. That means, how do you consider the total income? Income which is produced by the domestic, okay, the people who reside in India, they produce goods. Along with this, people who reside out of India, that means domestic people who reside in India, and the people who reside out of India, that means people in the foreign countries who are Indians. So all these people, they produce goods and they'll bring back the returns to your parent country, then you'll get it added to a GNP. So what is the formula of GNP? GNP is equal to GDP plus net factor income from abroad. So GDP, that is something you are producing within the country, plus something you are getting from out of the country, net factor income from abroad. That is Indians who are working abroad, Indians who bring those income from abroad, minus foreigners also are producing some goods in India, so they will take away to abroad. So this is the formula of GNP. So in case if you have any doubt, which has already been covered this topic, in case if that is the case, you can always post the questions which we can take it. So the syllabus which has not been covered as of now will immediately shift to that, that is money and banking. Money and banking is what we are going to cover in this class. See, what UPSC is expecting from you is very important. Every year, there are around 2 to 3 questions which have been asked from money and banking. So a candidate must have a very good knowledge. Earlier, the questions which were asked in money and banking was very basic questions. Now the question has gone very high level. That means in the money and banking chapter, UPSC always connects these to the inflation part. So little bit of more knowledge would easily help you to understand what is the question and to understand how to eliminate the options. We'll consider that. Now, we all know in India, Apex Bank is the Reserve Bank of India. So Reserve Bank of India is an apex bank. Apex bank means a central bank which is having an authority to regulate everything in the country. It regulates all the banks and you call it as an bankers bank, and it is a central bank for all the banks in India. Along with this, RBI is a lender of last resort. That means bank has always an option that in case of crisis, it can always revert back to RBI for its immediate financial crunch or anything, the crunch which is going to come in the future. So for any such of circumstances, RBI is always available for the bank. It is framed based on two acts. It works on the principles of two acts. One is RBI Act 1934 and Banking Regulation Act 1949. And if we could understand more about RBI, if you want to understand more about RBI, remember RBI was itself a private bank. He never considered it as a government bank. Now it is a government bank, but earlier RBI was itself a government bank. It was a private bank. Now based on Hilton Young Commission's suggestions, RBI Bank was established, okay, in 1935. They established RBI in 1935 based on Reserve Bank of India Act 1934. Now, later they felt that the RBI bank is very important bank and let us nationalize it. In the next class, I'll teach you what is nationalized bank, public sector banks, private sector banks, etc. So they thought they will nationalize it, and they nationalized in the year 1949. So in 1949, they have nationalized it. And from on, it has taken the responsibilities of the Apex Bank. Now, RBI is the one which will perform all the functions in the country. It has two important tools. One is quantitative tools. Other one is qualitative tools. What is quantitative tools and qualitative tools? These are the tools which RBI will consider so that the regulatory mechanism, banking functionality, structure in the banks can be maintained. Regulatory mechanism, functionality, structure in the banks can be maintained. So RBI has two important functions. That is, it is acting as a banker's bank, and it is also a very important bank, which is also called as the lender of last resort. Now, what is, first we'll take qualitative. Qualitative means quality, betterment, improvement, your functioning. All these are part of qualitative tools. Now, when you consider qualitative tools, there's always a better option, important, that you need to maintain quality in the structure. What is the quality you want to maintain and where? You maintain quality in banks. You have to maintain quality in the banks. Now, just a second. Sorry. You need to maintain quality, betterment, improvement, the functionality of the banks. So what all RBI is doing, it is doing for the betterment. It comes with the rules, regulations, so that its quantitative measures can be met. Now, if we consider these banks, remember the most important point here is I will come up with certain norms. RBI will make certain norms. RBI will make and come out with certain rules, and it is your responsibility to maintain these rules and norms. Now, next, RBI also has a most important power, which is called as moral suasion. This can be asked in your exam. What is moral suasion with respect to the qualitative tools? Moral suasion means in times of financial crunch or financial crisis, RBI has every right. That is, RBI has every right or authority to take decisions. RBI has every right or authority to take decisions on behalf of the banks. That means, see, monetary policy committee. What is monetary policy committee? This monetary policy committee is a very important committee which will set all the functionalities, how the banks has to work. They'll come up with the norms. They'll come up with the rules. They'll make certain functions. Okay, they'll set the interest rates. They'll set the repo rates and how well the money supply in the market can be maintained. RBI target is always to maintain a certain percentage of inflation. Always remember in our classes or when in your preparation that inflation is always present in the market. Inflation is always present in the market. How much inflation you have to maintain? That is 4 plus or minus 2 percentage needs to be maintained. And why do you have to maintain inflation? Why do you have to maintain inflation in the market? Because inflation is very important so that the producers can actually get a good returns. Foreigners can get a good returns. And inflation has to be affordable because it should be a win-win relation between a producer and a consumer. Now 4 plus or minus 2 means it should be between 2 to 6 percentage. So what is RBI doing here? RBI is trying to maintain the inflation between 2 to 6%. And how it is maintained, how it is reduced, this I will teach you in the next coming days. Now, remember, moral suasion, all this will be part of this monetary policy committee. So what is this committee doing? This committee has 6 members. 3 members, these are appointed by the central government. Who are these people? Who has a very sound knowledge in finance. So central government appoints 3 important members from their side into the monetary policy committee who has a very good knowledge in finance. Other set of people are directly the members of RBI. Who are these members? 2 are the regular members of RBI and 1 is governor. One is a governor, could be a deputy governor next member, or could be you can generally write down they are the members of RBI. Now out of 6, governor is going to head this MPC. So head of the MPC is governor. How does this look like? MPC, governor is going to head, and you have member 1, you have member 2, you have member 5. So how many members are there to overall? There are 6 members and 5 members other than governor, and governor is a head. Now these 2 are from RBI and 1 is also from RBI, governor, and other 3 are appointed by government of India. So who are these people? Scholars, economists, people who have a very good sound knowledge in economy. So those are the people who are part of MPC. Now who is head? I mean, like, who is the head of the MPC? It is RBI governor. Now in terms of a tie, for example, 6-6 and the 6 sit in the other way. So in terms of a tie between RBI and between the government of India, there is always a casting vote. The way you give a casting vote to the speaker, in this case, casting vote is again to the governor. So governor decision is the final decision. So Monetary Policy Committee at least meets 4 to 6 times in a year. Monetary Policy Committee has to meet at least 4 to 6 times in a year. And what they will do, they will always set the inflation rates. They will check the interest rates, how the functionality of the bank is working. Okay, so what are the measures they need to take? So all these things are part of your Monetary Policy Committee's daily responsibility. Now, within this, if I say there could be certain issues between this appointed members and the members who are part of this RBI. Now, whenever there is an issue, governor decision will be the final decision. Now, accommodative stances. Accommodative stances. See, in general, RBI meets, whenever it meet, that is MPC committee meet, it will try to change the interest rates. And nowadays, we are going to follow the accommodative stances. What does it mean? Accommodative stances means in case if the RBI is not changing its policy rate means inflation setting rates, what is the interest rate, what is the repo rate and all. In case if RBI is not going to change its policy rates, then that means it is continuing its previous policy rates in the present financial year or in the present quarter also. So in that case, RBI is following accommodative stances policy. Remember, RBI will follow accommodative stances policy. So accommodative stances is very simple. Earlier, you used to follow certain policy rates. Now also you are following the similar policy rate. There is no difference at all. This is called as accommodative stances, which are taken by Monetary Policy Committee. Now, quantitative tools, I told you, quantitative tools, and I've also told you qualitative tools. When it comes to qualitative tools, I told you like qualitative tools to maintain the quality, betterment, improvement, etc. Along with this moral suasion. Now, who has this power of moral suasion? Obviously, RBI. In the absence of banks, RBI has an every authority, okay, and a power to always take decisions on behalf of the individual banks, which they have done in COVID sessions. So, what is most important part? That is in quantitative tools. So entire your UPSC will concentrate more on quantitative rather than qualitative. Qualitative is much theoretical. Quantitative is very technical. Now quantitative tools. Quantitative tools. Now, for example, let me ask a small question. On which of the following recommendations RBI was established? Please answer on the which of the following
Sir, Hilton and
recommendations.
Telephone, sir.
Okay, good. Others? Is it true? Okay. Okay, no problem. Now, remember, it was based on Hilton and Commission's recommendations. Now, if I take quantitative tools, what are quantitative tools? Quantitative tools includes liquidity adjustment facility. Second one, bank rate. Third one, marginal standing facility. Okay. Fourth one, standing deposit facility. Call money and call rate. Okay, these are the most important quantitative tools Making use of it, RBI will control the money supply in India. Okay, making use of quantitative. Quantitative means what? In very simple language, it is number. Money supply is related to number. So I'm controlling the money supply, making use of these quantitative tools, and how better I am going to perform this task. Now, prior to getting into all these things, let me teach you basic thing. What is the functionality of a bank? What does bank do? Bank will provide you loans. It will also accept, banks will provide loans and it will also accept deposits. Now remember, on loans, bank will charge interest rate, and on deposits, banks has to provide you interest rates. On the both of the following, okay, interest rate is charged, but loans interest rate is higher than deposits. Now what is the term health of the bank? What do you mean by health of the bank? Health of the bank is nothing but NDTL. So what is NDTL? Net demand time liabilities. Net demand time liabilities is nothing but the health of the bank. So let us divide them. What is net demand? Net demand means you go to an ATM, you go to bank. When you have certain deposits with that bank, if you demand net demand, how much you are demanding, 1,000, 10,000, 1 lakh, provided that should be in your account. Now, once you demand those money, it could be any percentage, the banks cannot deny you. Banks have to pay you that money because it is your money. This is called as net demand. Time liabilities you cannot demand, but you can withdraw after a certain period of time. Once that has reached maturity, that's the reason we are calling as time taking liabilities. Don't disturb them for 6 months, 1 year. Don't disturb them for 2 years, 5 years, so that banks can actually provide you certain interest. After 2 years, 3 years, you can withdraw along with the interest. So to immediately get some benefits out of time liabilities, you have to make sure that certain period of time you will keep them in the bank without disturbing them, so that government or the banks can give you certain interest. These are called as time liabilities. Now along with this, what is net demand? Net demand includes your savings account as well as your current account. See, for example, you enter an ATM. You enter an ATM, you'll get an information like once you place the card, he'll give you select the account type. One will be savings account, other one will be the capital account. You'll definitely go to savings account. Now, what is the difference between a capital account or a current account or the savings accounts? Now, basically, you get to see the two accounts only. One is savings account, other one is current account. Now, what is the difference between a savings account and current account? Is savings account is basically for the income holders, basically for the income holders, whereas current account is for business class. Current account is for the business class. See, in general, if you have any organization and you are running this organization, so in this case, your number of transactions in a day will be very, very high. Your number of transactions will be very, very high in a day. And number of amount, the percentage of money which will also be transferred will also be very high. Okay, which could also be very high. So number of, see, business has to give salaries, business has to clear the bills, business has to pay the rent, business has to give it for some water supply, electricity bills. That means business units have so many options. to clear up because their expenditures will be high. That business units will have many components included, and hence number of transactions will be very more in the business unit of the current account, and hence they are not charged like us. For example, you go to ATM on a savings account, they'll ask that to maintain a minimum balance of 10,000, 1,000, etc. Now, once they will give you certain, once they will give you certain limited transactions. That means if you have a saving account, if you go to bank, you can withdraw only for 7 times. After seventh time or 10th time, they are going to charge you penalty. That means 20 rupees on such withdrawal. Now, for the business class, number of withdrawals will be more, transactions will be more, and hence I'm not bringing you into this. The restrictions. Restrictions are there for the savings account, and there are no restrictions for the current account. Number of transactions are more in current account. Number of transactions are very, very less in the savings account. In business account, number of transactions are more. Amount transfer is more. And you have many options under the business account. And for income holder savings, it is very limited options. For example, interest rate on the savings will be very, very less when compared to current account whose investments, current account whose the amount will be definitely huge, deposited amount will be very much huge, transaction amount is very much huge, and in that case interest what you get it in current account is always higher when compared to savings account. This is one option. Now there is a policy of overdraft. Now what is overdraft? Overdraft here means, for example, if you have 50,000 in your account, but you need to meet 80,000 as your some expenditures. So you need 80,000, but you have only 50,000 in your account. So when you're a current account holder, government will provide you, sorry, bank will provide you 30,000 from its pocket. It will give a message, it will drop a message that, are you interested to go for the overdraft policy? That means you have only 50,000, but you can give 30,000 extra from the bank and you can clear your issues. Same way, savings account, okay, you can use the amount what is you have. You do not have overdraft policy in savings account. That means you go to ATM and if you want to withdraw, okay, they will give you the money only what you maintain as a percentage, but they will not give you something more or less also as per your demand. But whereas in the current account, it is only the overdraft policy, it is only the overdraft policy which is applicable to the business class or the current account, where you can take more and you can always return back. It's like a credit card, or it's like taking loans. So you will not approach every time, but within the account only transactions are being made. Okay, this is about net demand of the health of the bank. And what is time liabilities? See, very simple. Time liabilities include those things which you have made as an investments or deposits, which is actually taking some time to give you results. What are those? You have gold, you have bond, you have okay, land papers, you have made some investments in insurance sector, health sector, etc. So all such things which will take some time, they will take at least 1 year, 2 years, or 3 years to get back those results. That means till that time you're not going to get result. Till that time you're not going to get any interest on such deposits. That's the reason we are calling them as an time liabilities. Bank is liable to pay you back once it reaches certain period of time. Example, your maturity. So put together, we call it as an NDTL, which is net demand time liabilities. So if you have any doubt in NDTL, please ask me. I'll give you a minute time. If you have no issue, please drop me a message. We'll go to the next topic. Understood? Okay, you have no doubts. I hope you guys are following the class. All right, that's great. So let me take the, again, let's go back to the previous concept. Let us go back to the previous concept. Is there any limit for the overdraft in case of current account? See, that's a very good question. Is there any limit for the overdraft in the case of current account? I'll take this question first, then I'll go to the next topic. See, definitely there will be a limit. Definitely there is a limit. For example, I have a business. My business worth annual turnover in the year is 10 crores. I also have a business which is 10 lakhs. So you can easily answer now, which of the following business will get overdraft? More overdraft for this one. You'll get more returns for the business because you are most trustworthy, because you have 10 crores capital which has been deposited in my bank, and whenever you need, you'll take it. But this time you're not having sufficient funds, so you took it from me. So in that particular case, we can say that this business set of classes which have the huge capital will definitely get more returns when compared to the other set of returns, other set of the other areas like the business units which whose capital is very, very less. They also get it overdraft, but in comparison it is less, I'm saying. Both are eligible for overdraft, but in comparison he'll be getting more time period. Definitely I'll give you more time period because you're my prime customer. You are my prime. You are my prime. I'll definitely give you benefits. This is called as an overdraft policy which are given to the banks. Now when I take quantitative tools, before taking quantitative tools, let me take one more topic there under this quantitative tools. Time period. Time period of lending. For how long you can lend? What is the time period that you have to lend here? What is the time period of lending? We have three time periods. One is very short term. Second one is short term. Third one is long term. So we have very short term, and a long term. So what do you mean by very short term? Very short term means time period is less than 1 day, or it is less than 24 hours. This very short term is related to call money. Very short term is called as the call money. Okay. Now, what is call money? Call money is the money where the transactions are happening between two banks, from bank one to bank two, and it is called as interbank lending rate system. That is interbank system where your lending and borrowing activities are taking place. Now, along with this, what is short-term period? Short-term period includes your liquidity adjustment facility. I'll come to this because I made you write there. Liquidity adjustment facilities, which includes your repo rate, which also includes your reverse repo rate, and the time period for this is greater than 1 day to 14 days. So 1 to 14 days. 1 to 14 days is the time period of is the most important time period of the short-term lending or short-term money borrowing from the RBI. And long-term is now greater than 14 days. Okay, one is for very short term, which is done on instant, that is 1 day less than 24 hours. Next one, if we take, it is a short term where the time period is greater than 1 and less than 14. That means it's between 1 to 14. And long term is greater than 14, right? So that is a very, very simple now. Now, what is that we are going to do with all these terminologies? We are going to take one after other and we are going to solve this. Now, I'll tell you time period. I'll repeat the time period again. Time period, if it is 1 day, you call it as call money. Time period, if it is 1 to 14, you call, repo rate and reverse repo rate. If it is greater than 14, it is called as bank rate. Call money, repo rate, reverse repo rate, and bank rate. So all these are how are they classified based on the time periods. Based on the time period, they have been getting classified here. Now we will take a very, very important term. We'll link this with the quantitative tools. So what did I say? What is the first topic under quantitative tools we have taken? For example, imagine there is a bank and they have started bank with this rupees 100. An example. So the bank with is rupees 100. So all these 100 rupees I cannot give in loans. Why? Because it could be a threat to me, financial threat. So that is the reason out of this 100 rupees, 4% I will make, okay, as an compulsory norm, thumb rule, which needs to be maintained with RBI. So this concept of maintaining this 4% with RBI is called as CRR, cash reserve ratio. It is a minimum ratio where every bank will deposit certain returns. It is a minimum reserve that every bank will deposit certain returns or the ratios with the Reserve Bank of India. So bank is depositing certain ratios with the Reserve Bank of India is called as CRR. Now, the same bank also have to deposit with itself the 18% reserve. Okay, these 18% reserve will not be with the RBI. It will be the bank. You call it as an statutory liquidity ratio. So what is statutory liquidity ratio? It is a minimum ratio, okay, where every bank has to deposit with itself certain statutory reserves. Certain statutory reserves you have to maintain with yourself. As for both CRR and SLR, they act as what? Security. They act as an security reserves. One you are keeping it with RBI, other one you are keeping it with yourself. So total all 22 rupees you cannot touch for loans or any lending activity. So 22 rupees you cannot touch, 18 plus 4, and you always has to keep it as an reserve ratios. These are called as reserve ratios. These are called as reserve ratios, which are CRR and SLR. Other than these reserve ratios, we have now we'll go to the regular the topic which we have left now. Now we have something more than security reserves. That means I told you started a bank with rupees 100. 4 and 18, it becomes 22. You remove 22, you will be having almost 68 rupees with you. 68 or 78 rupees, sorry. You have 78 rupees with you. Now this amount you can rotate in loan. With some criteria I will teach you again. So 14 and 18 and 4 you cannot touch. Those are like a rigid. They cannot be taken out without the RBS permission. So you cannot use 18 and 4 because it is only for the security. Now, just give me a second. Yeah, welcome. Now we will take one after the other, then we will see. First, we have discussed what is CRR. Now, I already told you CRR is nothing but cash reserve ratio, where every bank, okay, every bank has to deposit this with the reserve bank as with a security reserves. These are like CRR, will you'll keep it in the cash form, in the cash form with the reserve bank. Now, every bank has to put it with itself. Will have to park with itself what is SLR, okay, which is 18%. Now, CRR is 4%, which is only in cash. SLR is not in cash. SLR can be placed in many forms. You can place it in our rupee currency, you can place gold, you can place bonds, and it can be anything. That's the reason we are calling it as an SLR, liquidity. You are maintaining liquidity here. So out of this, which is most liquid? Can someone tell me what is liquidity? Can please someone tell me?
Cash, sir. The cash is more liquid, sir.
Cash is most liquid. Okay, may I know who's this? Ashraf.
No, sir. Also Vishash.
Okay. So anyone else? Which of the following which is most tell me what is liquidity, by the way? What do you mean by liquidity? What is liquidity?
So liquidity means that in case of cash, actually the flow is more, sir. So
Okay.
therefore, that is a liquid product.
Okay, almost. Okay, let me tell you. Liquidity means flexibility, my dear. All of you have to remember this. Liquidity means flexibility. Understand? Flexibility means how flexible you are using a commodity for exchange. For example, you go to bookstall. You go to a bookstall and here you'll buy a book. You have many options, dear. You can give rupee, you can give gold, you can give bond. Which of the following he will accept? He will accept everything. But which of the following he'll accept is rupee. So rupee is the one which is the most accepted to buy this book. So which of the following is most liquid, most flexible? It is most adjustable is rupee. So that is the reason rupee. Next comes gold. Next comes bond, because bond will take a lot of time than gold. Then, for example, next comes your land papers can also be asset. That also takes time. But to convert that to into the rupee form, it is taking time. That is the reason in the market they would have accepted gold. They would have accepted your bonds to buy this book, but they're not accepting is only a reason is they will accept most liquid forms because it could be useful for them and for you also because it can easy trade. So this is the meaning of liquidity. Now, along with SLR and CRR, there are other things which you should understand. That is what, see, I told you like CRR, you'll make it as 4 rupees. SLR, you are making it as an 18 rupees. Put together, they are 22. Now 22 means what is left? 78 rupees is left with me. This I'll give it in loans. This I'll give it in loans. Now imagine you're done with the 78 rupees and you don't have money with you. So what will you do when you don't have money with the bank? Then there's options. What is we are going to discuss? Liquidity adjustment facility is what we are going to discuss. It comprises of the repo rate and the reverse repo rate. Now, first one, repo rate. Repo rate mechanism. Repo rate mechanism means when a bank is in need of money, it will approach RBI. Bank is borrowing money from RBI by depositing certain collaterals. So what do you mean by collaterals? Collaterals means securities. By depositing certain collaterals, see, for example, you go to bank and you take loan, then definitely the interest rate is charged. Same thing, bank is taking loan from RBI, then 100% interest will be charged. This interest rate charged by RBI on the banks is called as repo rate. As of now, it could be 5%, 6%. Don't mug up all these numbers. Now, now what could be the reverse repo rate? What could be the reverse repo rate? Reverse repo rate means at times when RBI is need of money, at times when RBI is need of money, it will borrow from the banks. RBI is in need of money, it is borrowing from bank. Remember, RBI will not go for printing of money. Printing of money is the worst case. That will definitely inflate the market because it will add a lot of money into the market. That's the reason we don't go for printing of money. Now, along with this, RBI also have to deposit collaterals. Collaterals means securities. They are taking loans from the banks. They will deposit collaterals and they will take loans from the bank. And banks will charge interest rate on RBI and its loans. So this is called as reverse repo rate. Okay. In one case, bank is borrowing. In the next case, RBI is borrowing. Once you are borrowing, other person will definitely charge you interest, and he also thinks that you have to park certain collaterals. So in the both the cases of RR and triple R, collaterals takes place, the role of collaterals is present. Along with this, an interest rate is charged. Now, which of the following is higher? Is it RR is higher or triple R is higher? RR is always higher than triple R. You're working under RBI. Okay, when RBI is borrowing from you, that means you cannot take a chance to charge more interest on the RBI. You have to charge very less interest. And who's deciding this triple R? It is only RBI deciding. And who decides RR? It is also decided by RBI. So no bank decides RR and triple R. It is only RBI which is deciding. Now you might be getting a thought when RBI is deciding and when it is borrowing loan, it will definitely reduce the reverse repo rate so that it can pay very less interest. True, because it is being decided by RBI only, and we are working under RBI. RBI is not working under us. RBI is the supreme authority. Okay, that's the reason triple R is always lesser than RR. Now there is one more concept. For example, today morning we met in the class and you said, sir, I need 5 lakhs. So I'll give you, he'll say that I'll ask you like, why do you need, sir? I need loan. Okay, chalo, I'll give you 5 lakhs. Now I'll say that, dear, you have to pay interest and you have to give me collaterals for this. For securities, I cannot give you. So he says, okay, sir, give me 5 lakhs and I will charge, please charge interest rate and please give me collaterals. So imagine I'll be charging 5% interest rate. On the next day morning, you came to me again, sir, I need 3 lakhs more. I need more 3 lakhs. 5 lakhs is not sufficient. Now you say, this time I do not have collaterals. There is no collaterals. So what collaterals I have already have given to you for 5 lakhs. For extra 3 lakhs, I don't have collaterals. I will say, okay, fine. I will give you loan again. I'll sanction you loan again. There is no issues. But tell me, interest rate for 5 lakhs will be higher. Interest rate for 3 lakhs will be higher. Please answer this, everyone.
So 3 lakhs will be higher because there is no collateral security.
Yes, very nice. Anyone else? 3 lakhs. Very good. Obviously, 3 lakhs will be higher because there is no collaterals. When there is no securities, why do you think that I will give you at a low rate of interest? So apply this, remember this mechanism in the mechanism of taking loans without collaterals, interest rate will be higher. Now, let me tell you one important point here. Let me consider one important point here and let me teach you what is bank rate. So you have learned now what is repo rate and what is reverse repo rate. These are basically, they are for short term. They are for short term. Now, what is the meaning of bank rate? When do you go for bank rate? Bank rate, we go it for when we need of money in the long term cases, long period of time. I already told you long term period of time greater than 14 days if you're going for loans. Liquidity adjustment facility, repo rate and reverse repo rate, it is hardly, I mean, like it is for 1 to 14 days. And call money, it is less than 1 day, 24 hours. Now, what is bank rate? Bank rate is the rate that is when the bank is in need of money from RBI. Bank is in need of money from RBI. That is, it is borrowing money from the RBI. Okay. And there is no deposition of collaterals. There is no deposition of collaterals. On such, is an interest rate charge. On such, there is an interest rate charge by RBI on such banks is called as bank rate. Okay, without any collaterals. Now I'll give you a small question. Please answer to this question. RR, bank rate, triple R. RR, bank rate, and triple R. Arrange them in the order from highest to lowest interest rates. Arrange them in order from highest to lowest interest rate. Others, everyone has to answer. It's not like one or two. Okay, Muhammad Ismail says bank rate, repo rate, reverse repo rate. Mubashira Begum, bank rate, repo rate, reverse repo rate. How about others? Is it correct what they have posted? Yes, definitely correct what they have posted, because understand, it is the bank rate which is higher because it do not have collaterals. It do not attract collaterals. So bank rate is higher than repo rate, and repo rate is higher than reverse repo rate. So this is what we have learned. Now let me take one more point here so that it can benefit you. Okay. Now what have we discussed? We have discussed the CRR. We have discussed SLR. Okay. We have discussed the liquidity adjustment facility, repo rate, and reverse repo rate, and we also have discussed bank rate. So I hope you will might not be having any doubts in this. Now I will link these topics to inflation. Now let's check how does this work when we link these topics to inflation. And remember, what is inflation? How is that you're going to link this inflation chapter to this basic inflation chapter to the basic monetary tools? Imagine Imagine there is a case that there is inflation in the market. Imagine a case, inflation in the market. What is the basic definition of inflation? Inflation says there is more prices in the market. Simple definition of inflation is the average value of the goods and services over a period of time increases. Okay, or gradually increases, you can say. This is called as inflation. Now, why there is inflation? Major component in the banking is money supply. Major component in the banking is the money supply. Money supply is more. Okay, money supply is more. When the money supply is more, investments are more. Money supply is more, investments are more. When the investments are happening more in number, obviously demand will increase. Okay, when obviously demand increases, prices will also increase. Okay, so investment increases, demand increases, basic prices increases. Now, due to increase in these prices, there is inflation. Now, what should I do? What is my responsibility? My responsibility here is to control the inflation. My responsibility here is to control the inflation, keep the market stable to control the inflation. How will I control the inflation? Control the money supply, because how do you what is making inflation in the market? Money supply. Now you control the inflation because there is more money supply. So during inflation, already the money supply is very high. Already the money supply is very high. So what will you do? I have to target this money supply so that this money supply need to be reduced. This money supply has to be reduced. Now, how will I reduce the money supply? That means I will target banks. From these banks, you're taking loans, and to these banks, you're accepting deposits. Okay, you're taking loans and you're also making some sort of deposits. Now, smartly, when there is inflation, what RBI will do? When there is inflation, RBI will very simply increase the interest rates, will advise the banks, please increase the interest rates. That means bank rate is a long-term rate which is has also increased. So bank rate is high. Repo rate has also increased. Repo rate is also high. Now how does it happen, sir? Bank goes to Reserve Bank. Bank goes to Reserve Bank, where the Reserve Bank, okay, is providing loans. Reserve Bank is providing loans for certain period of time. Okay, certain period of time. And by depositing the collaterals, the bank has taken the loans. Now, why did we all of so sudden brought this bank rate or repo rate? It could be anything. Bank demanding from RBI, demanding from RBI that I need some loans. Okay, and I cannot give collateral. This is bank rate. Now, in already the market, the interest rates are very high. So what RBI will do? It will advise the banks to increase the interest rates. That means now the interest rates will be high. Earlier, repo rate, you would have paid 5%. This time, you from here on, you will pay the 6% repo rate. That means banks are paying, instead of 5%, banks are paying high interest. Instead of 5, they are paying 6. When banks are paying more, do you expect that you will be left aside? That means you are also here. Whenever you check the loans from the banks, there will be a charge of interest rate which is higher. Okay, remember, very simple topic. Inflation. What is inflation? Inflation is nothing but increase in the values and commodities over a period of time. That's it. The prices have gone very high, which is resulting in inflation. Why there's inflation? Money supply is more in the market. That's the reason there is inflation. Okay, money supply is more in the market, investments are more, demand is more, and due to such demand, the production has to be high, or there is an inflation in the market. We can conclude here. Now, when there's inflation in the market, what RBI do? RBI has to control it. How RBI will control? It will say to the banks that I am from here on increasing the repo rate. So who gets loan from repo rate? Banks. So banks will easily, okay, banks will easily pay. I mean, like, is it easily payable or not? It is definitely not easily payable. Why? Because earlier banks used to pay 4%. Now banks are advised to pay at 6%. That means you are paying something more than previous year. So when you yourself are paying more, do you think this person will get costly loans, or do you think the person will get cheap loans? Answer this question. Will he get a costly loan or cheap loan?
It's a costly loan, sir.
Obviously, when banks themselves are taking costly loans, why do they give you cheap loans? They'll definitely give you costly loans only. Now, what happened when there is a costly loan in the market? Costly loans will reduce the loans in the market, because loans are very high now. Loans are like very much huge. I mean, like loans used to be very much huge now, but interest rates on loans are very high. So loans will come down. People are not interested to take loan because interest rates are increased. Why interest rates are increased? RBI has increased. Why RBI has increased? Money supply is increased. To control this money supply in the market, I need to increase the bank rate, repo rate, interest rates. Whenever these people come to me, now they will stop. Why? They will delay it as the interest rates are very, very high. So what they will do now? Now loans due to high interest rates will come down, but deposits will increase or decrease?
So deposits will increase.
Very nice. Deposits will increase. Why deposits will increase? Because instead of keeping this money in your pocket, you rather go to bank and deposit. You will get more interest because now interest rate is high. Interest rate is high. That's why we are not taking loans. Interest rate is high. That's why we are going and deposit in banks. What does this creates? It creates a very confidence level in the money market, capital market, share market, banking market system in India. Now, simply they will increase the repo rate, they will increase the bank rate. This will have an huge impact on the banks. From banks, it will have impact on the end users. This is how, by reducing the loans, less money supply is given into the market, and by increasing depositing, whichever the percentage of money which is there in the market, which will be pulled out. So it should be an increase or it should be a decrease. It can be anything, but depending on the situation of inflation. Okay. Now please write down the conditions. Please write down the conditions for deflation. And just pause that. Let me check how much you understood. Write down the conditions of deflation. How that the RBI will control deflation? That is what you have to write. Okay. Let me check the answer. Decrease bank rate, repo rate, or triple R. Obviously, when you decrease them, what will happen? Now, why there is an deflation? Why there is an deflation in the market? Because look, money supply is less in the market. When money supply is less in the market, what will happen to investments? Will also be less. People don't have money. That means people are not ready to invest also. The investments are less. When investments are less, demand will go low. When demand will go low, that means demand will go low. What does that happen? That means people are not going to buy that good. That means prices will come down. So the gradual fall in the prices at certain period of time is called as deflation. Now, how will you control deflation? You will advise the banks. I am going to increase the repo rate. I am going to increase the reverse repo rate. That means banks are approaching RBI. Banks are approaching RBI, and banks will pass on this money to them. Okay, because banks are borrowing and collaterals are placed. Okay, so this chart is called as repo rate, and how much is charges that repo rate it could be, or it could be the interest rate, repo rate or interest rate. Now during deflation, repo rate is reduced. During deflation, you are going to reduce the repo rate. What happens if you reduce the repo rate? Bank will get cheap loans. Bank themselves are getting cheap loans. If someone, people like us, approach the banks, definitely they'll give us at a cheap rate of interest. So during deflation, repo rates are reduced. During deflation, repo rates are reduced. This repo rates are reduced. What will happen? People will take more loans. Loans will increase, and deposits will decrease. Okay, loans will increase, deposit will decrease. That means more people are interested to take loan. They will go and invest in the market. Obviously, when they invest in the market, prices will increase, demand will increase. Finally, they will get more returns. This is how inflation and deflation are managed in the in the in the scenario of the market. Okay, so I hope for you CRR, SLR, bank rate, reverse repo rate, call money, and the most important component, how to make use of these elements to control the inflation and deflation in India. All right. So is it clear? Any doubt till here? What is taught? Any doubt till here? What is taught in today's class? Just refer your class notes. What I'll give you a minute time. Just refer your class notes. Okay. I hope that there is no doubt, so that I can go ahead with inflation linking of for your repos is very, very important, because most question comes from here, and make sure that you don't make a single mistake. Okay, we are done with CRR, we are done with SLR. We have also covered inflation, deflation, repo rate, and reverse repo rate, bank rate. Okay, now what is call money? What is call money? Example, it is interbank. It is interbank lending rate options. You have A here, you have B here. So one is lending, other one is borrowing. So bank A needs loan, for example, for immediate transaction, they have to close. So they need not run for RBI always. They can have an interaction. Two banks can easily have an interaction, and this interaction was done based on the recurrent requirements of 1 crore or 10 lakhs you need. Immediately you'll call, like the other bank, you'll advise them to send, you'll they request them to send the amount to us, so that we can actually tally our balance sheet in the daily. So it is an interbank transaction. So when two banks are interacting, we call it as call money, and an interest rate has to pay on it. Obviously interest rate has to pay. So then it is called as call rate. Call rate is a rate which is charged on those individual banks who are trading in money. We are related to the for their own requirements. So this is called as call money. Now what is call rate? Interest charge on these transactions. Interest charge on the call money is called as call rate. Now who sets call rate? Call rate is set by MIBOR. Okay, call rate is set by the MIBOR. What is MIBOR? Mumbai Interbank Offer Rate. This is an agency which is in Mumbai. Mumbai Interbank Offer Rate, which will calculate the call rate data daily on the basis of the Sensex. Okay, so Viber is an agency which will set the call rate, and it will consider the National Stock Exchange census. Okay, I will teach you later in SEBI what is National Stock Exchange, what are ADRs, GDRs, bonds, debentures, different types of bonds, etc. Now there, what is the meaning here? MIBOR is an agency. Okay, what it will do, its responsibility daily, it has so many responsibilities, but one responsibility is set call rate. Every day morning it will set call rate. Banks which will go for interbank trading or interaction, we can just look at the call rate. Okay, today call rate is 4%, so I have to donate at 4%. And later if it become 3%, someone will return back to me only 3% of interest. So Daily transactions are made, daily values are set, and most of these important values are set by this MIBOR only. For example, if you have interaction in international bank like Deutsche Bank, Standard Chart of London, Standard Chartered Bank, or you have so many other banks, if these banks interact for their international requirements also, it is LIBOR, that is London Interbank Offer Rate. If it is international banks, if it is international banks, it is by LIBOR. If it is national banks, it is by MIBOR, London Interbank Offer Rate, Mumbai Interbank Offer Rate. So these are about the most important topics of these are the most important topics with respect to your preliminary part. Now, let me tell you what kind of questions can be asked in your examination. Simple, link it with the inflation, link it with the deflation. They will ask you basic definitions and they'll try to link with the concepts. That is what we should know. What is the differences? What are the challenges? What are the measures taken by government of India? 3 individual units, so that you can easily understand which unit you have to write down. So what measures government will do when there is an inflation? Interest rate will increase, money supply will decrease. Okay, so this is the concept of inflation and other areas. Now we will also take one more important concept, which is market stabilization. Market We'll take first this concept about market stabilization. I will teach you OMOs. Marginal standing facility. Marginal standing facility. Let me write now. Marginal standing facility, MSF, marginal standing facility. So what is, let me write again for repo rate. So what is repo rate? When the bank is approaching the reserve bank, or when it is borrowing money from reserve bank, and when it will try to deposit the collaterals, and an interest rate is charged, which is called as repo rate. Interest rate is charged, which is called as repo rate. Now you are going, because you have collaterals there. When you have collaterals, you're going there because you have collaterals now. In case if you need loan, because you need loan here, you have collaterals. In case you need a loan, in case you need loan, okay, and you also, in case you need loans and you also have collaterals, you will go with repo rate. In case you need loans and you do not have regular collaterals, then you will go for marginal stabilization, marginal standing facility. Then you'll go for marginal standing facility. Now, how does this work, marginal standing facility? Let me take first marginal standing facility. How does this work? That means when you have no collaterals with you, what is left with you? It is SLR. So what RBI is saying, that I am giving you permission now because I do not have any collateral, then you have to close the bank then. That means how much is SLR we are maintaining? 18%. So bring 2% of your SLR. Bring not all, 2%, because you do not have collaterals. Now what is left with you? Only SLR. Take 2% of SLR and come to me. So what banks will do? Banks will approach RBI and okay, RBI is going to borrow or is going to lend to you, and you are going to give it to RBI. Okay, so you are going to give it to RBI. Now, one basic question I'll ask you: what is the basic difference between repo rate, marginal standing facility? I'll tell two differences. These differences are quite enough for you to understand the concept of MSF. First difference: RR, when you are in need of money. Who is in need of money? Banks are in need of money. And when it is MSF, MSF also is in need of money by the banks. This is the first point. This is not difference. This is commonality, but we'll come to difference now. Now you have regular collaterals with you, and you'll take these collaterals and you'll go deposit. Regular means additional collaterals. You take these collaterals and you get deposited them in the RBI and you take loan on these collaterals. Now MSF, you don't have collaterals with them. What is that you have? You have SLR. You don't have collaterals with you, but you have only SLR. So now bring this SLR. But how much is SLR with you? I'm saying that you are having already 18%. Can you take entire 18%? No, you cannot take any entire 18%, because if you take 18%, now nothing is left with you. You have to close the bank. So the RBI is saying that out of this 18%, bring 2%. What is this SLR? It is your NDTL, net demand time liabilities. So 2% of your NDTL, 2% of NDTL, you bring it to me, I will give you loan. So in NDTL, you have time liabilities, you have gold, bond, shares, etc. Now, what is that I'm saying? You bring 2% of those shares. 2% of what? You're 18. Now, how much is SLR left with you? 16%. So 2% of NDTL you bring to me and use this as an collaterals. That means bank will approach RBI and RBI will give you loan when bank, okay, comes with collaterals which are nothing but the SLR collaterals. So then the rate is charged is repo rate plus 1. See, in repo rate also you are going with collaterals, and in MSF also you are going with collaterals, but in repo rate you are going with regular collaterals. In MSF you are touching those collaterals which you are not supposed to touch, that is SLR. You're not going with regular collateral, but still you are going with collaterals. Collaterals you are taking it SLR, that is of 2%. So on this, as I told you that SLR you should not touch, you should not disturb. If you disturb, you need to pay penalty. Now you have disturbed the SLR. Now you will pay penalty. And as I mean, like you need to pay penalty. Why? Because you have used the SLR. How long will you pay till this 2% is adjusted? You bring back the 2%, make it 18%. RBI will not charge you, but that penalty is charged. That is called as MSF rate is equal to repo rate plus 1. Why repo rate? Because it is general. You are going for short term. You are borrowing from RBI, and it is for 1 to 14 days. And there is an interest rate charge. It is called as repo rate. And what is MSF? Something more than repo rate, because you are not touching regular securities. There's most issue securities or some other issue of some basic on your interest. So that's the reason you are touching up this SLR, which is not advised to do so. And 100% the RBI is going to penalty you. So penalty will be applied till those 18% will come back to the normal phase. So MSF rate, you're not only using RR, but you're making some disturbances to the structure. So that is the reason RBI says till you bring back those 18% to me, I'll be keep hitting you with the interest rate which is more than RR, and 1% here is the penalty rate, 22 plus 1. That is RR plus 1. In general, they call it RR plus 1. So repo rate plus 1 is MSF rate. So any doubt in MSF? Any doubt you have in MSF, please post it so that I can take the discussion of MSF. Any doubt in MSF? Any doubt in MSF? No doubt? Okay, fine. So I hope you're clear with the class. So what? Let me summarize. We discussed about the quantitative, qualitative, we discuss about CRR, SLR, bank rate, call money. Okay, bank rate, call money, and MSF, liquidity adjustment facility. So these are the terminologies which you have covered in today's class: CRR, SLR, bank rate, and you have MSF. Okay, call money, call rate, LIBOR, MIBOR, and liquidity adjustment facility, which includes your RR and which includes your repo rate and reverse repo rate. All right. So these are the topics which I thought I will cover today. Just revise these topics. In case if you have any doubt, you can always come back and you can talk to me related to these topics. Okay. Thank you so much, and we'll meet tomorrow.
Thank you, sir.
Is it clear? Is it clear, ma? All of you?
Yes, sir. Clear.
Okay. Thank you so much. Okay. Take
Yes,
care.
sir.